Well, hey there, everyone. Happy Tuesday, October 14th, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautiful fall day here in Redmond, Washington, the greater Seattle area. Thrilled at the first two games of the AL Pennant Series, the ALCS, with a win over Toronto back in Seattle tomorrow. So that's fun for those of us here in this area. Apologize to the Canadians who weighed in on the chat yesterday talking about Go Blue Jays. Did not see this coming, and hopefully we can have some good games continuing on. The series has been a lot of fun. Hope you're enjoying it too. Speaking of hoping we're enjoying it, S&P nice early drop, but a nice rally in the through the course of the morning, really right into the lunchtime hour Eastern time. The S&P ended up getting up to around 6680. Did finish slightly in the red. The NASDAQ composite even worse. Volatility back higher. So this wasn't a big sell-off day, but it certainly was not a big resumption of the uptrend day. I would say a lot of still very much open questions here. We're continuing to see strength in mid caps and small caps. We're continuing to see strength in some defensive sectors like consumer staples, which happen to be at the top of the leaderboard today. Earnings to talk about. We'll look at some of the financial stocks reporting here. Breadth conditions still not particularly strong. And I think that's for me, I think that's one of the biggest tells here, right? Measures based on breadth, which have been weighing on this market for a little while, I would argue. But we've talked about the market making new highs on weaker breadth. We are now seeing things like the Hindenburg Omen, which fired an initial salvo of bearishness on Friday. And again, the question now is, does that manifest itself into further deterioration? Appreciate you guys tuning in live on Facebook, LinkedIn, YouTube, and X. Great to have you join me. Those of you that are doing so live, you're always welcome to ask questions as we go. I'll keep my eye on the questions on all those platforms. Grab a question or two at the end of the episode, and we'll take a question or two at the end. As a reminder, I'm traveling tomorrow. Tomorrow's a travel day going down to Orlando. I'll be speaking at the Money Show, doing some podcast interviews. I've got an exhibit ready for the exhibitors hall. So please, if you're going to be attending, swing by in one of those places and say hello. Would be great to meet you in person. But we'll be talking about market conditions. We'll be talking about discipline and using different parts to your investment process. We'll be talking about some of our poor decisions we've made in recent months and recent years. So please swing by and say hello. All right, let's get to the charts and talk about what happened in the market today. So, again, I feel like this is one of those days that kind of frustrates everyone, right? If you're all bulled up, you're looking for Friday to be like a one-off thing, right? We sold off on Trump's comments over the weekend, kind of backpedaling, saying we love China, China's awesome, we really want to partner with China, and just hoping that just resumes this AI-fueled frenzy that has been in place almost consistently without pause since the April market low. We didn't get that. We see the S&P kind of retesting support, almost got down to 65.50 again today. It hit a low just below 65.60. If you're bearish, though, we're not getting that downside follow through, right? Friday's drop has been the low so far. So I think we're still sort of in that question mark period where it's unclear as to how this is going to resolve. By the way, my latest video on my YouTube channel that I posted at the end of last week was just thinking about different scenarios for the S&P. It's an exercise I love to do, looking at a very bullish scenario, a very bearish scenario, and some scenarios in between. Perfect time, I think, and I'd love for you to take a look at that video. Think about the four scenarios. Think about what that might look like. Think about what that might do to your portfolio, and then vote on which scenario you see as most likely. It's helpful to kind of force yourself out of your kind of framework, your narrative that you're kind of tied to. But also, I think it's really helpful to see what other people are thinking. Maybe they're seeing something you're not. Maybe other things that you think are not as important, someone else thinks is important. This comes from a number of meetings I used to have back in the day as an institutional investor, kind of comparing notes with others at the firm and just, debating and discussing different scenarios. And it helped us really think about the probabilities that we should be working with in our portfolios. We think about risk and positioning. So I hope you can check that out on my YouTube channel. Would love for you to weigh in for sure. All right, S&P closed just above 66.54. That's down 0.2% from yesterday's close. The NASDAQ down about 0.75%. from Monday's close to 22,520 and change. The Dow, the best performer of the three, did manage to stay positive through the afternoon, up about 0.4%. The real action, though, in mid caps and then definitely in small caps, all of these indexes opened weaker. But the question is, which of them were able to actually, experience some strong gains through the course of the day? Small caps doing the best. So the Russell 2000, the S&P 600, which are the two most commonly used small cap indexes, both having pretty decent days. S&P 600 up about 1.5%. Russell 2000 chart making new 52-week highs today, I believe, as I was glancing earlier at a bunch of index charts. The VIX kind of back above our warning level, right? So Friday with the sell-off, we saw a big spike in volatility. That's one of our most helpful red flags as I think back to things that have helped me avoid disastrous market moves. Big spikes in volatility are just one of those things, like a siren going off, a tornado siren, as my friend Adam Koch shared on my podcast a number of episodes ago. I think that's a great analogy for something like the VIX spiking, right? It's like a tornado siren. It doesn't guarantee that, everything's going to go horribly with a tornado coming right through your neighborhood. But I've learned it's a good idea to go down in the basement and just sort of, assume that bad things could happen. And then I protect myself and I make sure that they don't. And I would say the VIX popping above 20, like we saw on Friday. Monday, it kind of pulled back a bit, got down to around 19, but then Tuesday back higher. And that could be a problem. The more that the VIX stays above 20, the more that this feels like, what that's basically telling you is the options market's pricing in greater movements, right? Greater volatility in the S&P 500. And that usually means investors are getting nervous, right? We don't get optimistic and calm and happy and then have volatility increase. It's usually because of fear. All right, bond markets were closed yesterday for Columbus Day / Indigenous Peoples Day. Back open today, and you can see it's kind of a choppy, sloppy, sideways day for the bond market. Here on Tuesday, the TLT, which is a bond ETF that we track, so basically follows bond prices, up about 0.33%. We can see that the yield curve generally moved lower. Next Fed meeting's coming up here pretty quick, right? We're dealing with earnings season just kicking off this week with a bunch of financials and also like Johnson & Johnson, random other stocks as well. But over the next couple of weeks, we've got a ton more earnings. And in the next 2 weeks, we're going to get into a bunch of growthy names and have to report earnings. And I think that could be a really compelling, set of earnings releases to focus in on, to get sort of updates on aggressive spending on AI, on inflationary pressures and how they are, planning for that, on tariffs, which really have not had any meaningful impact on consumers to any significant way generally, right? We've not seen that reflected in weakness in stock prices, but there are some that are still thinking that tariff impact is just delayed. We've worked through a bunch of supply. Now we're just waiting for companies to eventually have to start raising prices. We haven't really seen that in any widespread way with some of these names, but maybe we start to hear that conversation in an earnings report. And with the lack of economic data, I think what companies are sharing in their earnings release is sort of all we have to think about price action and consumer sentiment. So could be quite important. We also have another Fed meeting coming up in about 2 weeks from this week. We have the October Fed meeting, comes in the last week of October, just before Halloween. Market pricing in almost 100% chance of another 25 basis point cut. That's sort of what we assume will happen at the October meeting and then the December meeting. So let's see. Elsewhere, let's see the dollar. Slightly lower, about 0.33%. Not a huge move, but something as always to be aware of. In the commodity space, gold up, pretty much everything else struggling today. Energy prices in particular down. Crude oil, natural gas prices, gasoline futures all rotating lower. On other sides, you see precious metals, probably the best area of the commodity space. Again, the GLD continuing to just make new 52-week highs like it's no problem at all. So interesting. One of the scenarios you have in mind as stocks and gold just continuing to trend higher, right? Sort of logically, you think one of these is probably going to give at some point, right? The idea that they would just be highly positive correlated in a bull market phase for stocks just seems logically a little off. Now that's happened plenty of times, right? Plenty of times that stocks and gold have gone up together. Earlier today, we've seen that, but this could be maybe that sign of a disconnection between those that high correlation. Maybe gold continues higher, turns into a serious safe haven as stocks rotate lower. that's certainly a scenario I'm thinking about going into the next couple weeks. A lot of red on the crypto page here. The crypto, what do we call it? Cryptogeddon. I don't know if I think it's a little too early to come up with a new moniker for what we're seeing so far, but it's certainly not going up anymore. Bitcoin coming down from the mid 120s as an all-time high down around 113,000. Ether prices just above 4,100. All 10 of the top coins here on stock charts in the red and generally drifting lower. Kind of trending higher through the equity session, but certainly keeping an eye on support there. Cryptocurrencies have become even more volatile here recently. All right, looking at the S&P 500 sectors. Defensive sector number one, consumer staples at the top of the leaderboard, up 1.6%. Anytime I see that, do you know what I do? I immediately look for consumer discretionary, because I know if consumer staples are at the top, then I know consumer discretionary is not on the top. And I know that staples have outperformed discretionary. And that immediately makes me think of that offense versus defense chart. I'll show you that here right now. The offense to defense chart, which for me has become just a super important way of thinking about positioning. I've been following a version of this chart for a long time. And one thing I've learned is when this ratio starts to rotate lower, that implies that investors are getting more defensive. And to have big rotations, usually you can assume that it's larger investors really starting to rotate positioning and getting more to the defensive side of things. I would argue we're certainly seeing that in the month of October, right? September, these ratios are both making new 52-week highs, basically suggesting offense over defense, things you want over things you need, conditions are good. In October, we're now seeing a rotation lower. And it's worth noting these ratios really started to turn lower last week before the big sell-off on Friday, right? You sort of saw that as a warning sign going into the last trading session last week. And so last week's sell-off kind of following through on that. So staples number one, and here's consumer discretionary still up, but only about 0.25%. So that's what's making that ratio go down today. You also have industrials, financials, materials all up just over 1%. And that's an encouraging follow through with some of those value-oriented sectors. Financials, represented by a lot of earnings this week, today, including a number of big cap banks. On the downside, technology down 1.3%. I mean, not a horrible down day. There's just a lot of market cap in that particular sector. Energy flat for the day with crude oil prices going down. Breadth actually wasn't bad today, right? So you have advancers over decliners in all of the major indexes. Here we go. So we can see in the New York Composite Index, which is the main one that I like to follow, 66% up, 31% down. So about a 2-to-1 ratio, stocks up versus down. On the S&P, even better, 77 to 22%. So what, 3.5-to-1 ratio. And in small caps, about a 4-to-1 ratio. So with all the major U.S. benchmarks, nice breadth today. The breadth, generally speaking, has been has turned pretty negative, I would argue, in the last month. But nice update with breadth conditions improving a bit. It shows you what can happen when technology is down and everything else is up. The indexes are still kind of flat to slightly lower, depending on where you're looking. All right, looking at the Magnificent Seven and Friends, and I grabbed 3 of these charts, I think, to review here in a few moments when we get to some charts, because I would argue, I mean, as always, these are truly important charts to watch because of their influence on the major benchmarks, right? So when one of these names, just one of them has a big move, it can cause a lot of problems. So I'll draw your attention to the bottom of the list. We've got some big tech having some big painful days. NVIDIA down 4.4% today. Broadcom down 3.5% today. Then we get into some of the consumer names. Amazon and Tesla both down over 1.5%. So in 2 of those, sort of 3 FANG sectors, right? The technology, communications, consumer discretionary sectors. Bottom 4 stocks down pretty significantly, certainly weighing on this market. And obviously, I'm most concerned, given the fact that this market has been dominated by absolute euphoria about the future of AI and how much we should pay for stocks now because of the future promise of that technology. The danger to this market is everyone, the music stops and we all start selling NVIDIA for whatever reason. And so days like today certainly remind us that that's a possibility. So friendly reminder, if you've allowed things like NVIDIA and Broadcom and Palantir and other growthy things like that to become a huge weight in your portfolio, That's what really helps you on the way up, and that's what will absolutely crush you on the way down, because things that accelerate higher can accelerate lower, often with little to no warning. And the problem is, as they get bigger, it becomes a bigger weight in your portfolio. And that's what we talk about trimming positions on the way up, is just to keep it to a manageable allocation, right? We don't want to make our entire portfolio about NVIDIA. Now, a lot of people do, especially individuals, and they tend to just make bigger and bigger bets as the stock price increases. All of a sudden, you have a one stock portfolio, and that's great as long as it's going up. But when it starts going down, that's when things create quite an issue. So we've been talking about diversifying away from some of those areas. Days like today remind me why that's something that we think about fairly often. All right, let's spend some time looking at the heat map, seeing what happened today, talk about some of the growth stocks that struggled, some of the other areas of the market showing some strength. I see lots of comments and great questions coming in on the different platforms upon which we are live streaming. Thanks everyone that is tuning in live. I appreciate it. As a reminder, if you're watching the video later on our YouTube channel, use the comment section there anytime. I read every question that comes through our live stream and through our YouTube channel. I'll hand select some of those for a mailbag episode, which we're planning on Friday. Again, not sure what's going to happen Wednesday and Thursday, just because of travel and doing a lot of stuff at the Money Show. But keep an eye on my YouTube channel. I usually use the community section there to update all my YouTube subscribers on what's happening with the show. So friendly reminder to subscribe to the YouTube channel if you have not done so already. And I'll certainly be posting some things there at least to keep you updated. Also, as a quick reminder, while we're paused here, two quick videos I want to remind you to check out. Our Market Misbehavior podcast. Just having so much fun talking to smart people that look at stocks and ETFs and options and other markets, and asking them questions about how they do what they do, what lessons they've learned, what advice they could give to all of us to make better decisions. Most recent interview was with Simon Rhee. Simon's the author of the book, The Tao of Trading, which I thought was just an awesome book. Great mix of mindfulness, technical analysis, routines, mindset, bunch of great investing quotes. Listen to that interview, and there's a link to check out his book, which I thought was really well done. Simon's just a genuinely nice human being, and I had fun talking to him. Also, recent interviews with Mary Ellen McGonigal, Frank Capillari, a lot of other smart technical analysts, analysis type people that can help you make sense of things. I'm actually sitting down later today with Tom Atkinson of FX Evolution. So those of you that mentioned that he gave a shout out to to my show on his, I reached out to him immediately, said, "Hey, would you come on the podcast?" And I'm interviewing him shortly, so look for that later this week. Should be fun. He's a great, knowledgeable trader, fantastic technical analyst, and brings a different perspective, a little shorter term than I am, and I find that really valuable. All right, continuing on here, a lot of red in the upper left corner, and that's what I think was the story of the markets today. When you look to the upper left, NVIDIA down, Broadcom down, Oracle down. That's, three of the top five weights in the XLK in the technology sector down 3-ish to more, to 4.5%. And that's a significant deterioration right there. Now, outside of those names, we see other things that are struggling, right? And it's some names that have not been particularly good for quite some time. So, Salesforce has been an underwhelming chart for most of 2025. Remains particularly negative, but we have Arista Networks, which had broken out, which now looks like a blow-off top as it rotates lower. Intel pulling back after reaching up to around $38 a share, starting to pull back from those previous all-time highs. Some of these aren't broken charts just yet, right? Dell and Intel, Intel and others made new 52-week highs just in the last week. But they're all pulling back from those levels, and that's what a major top can start to look like. The question is, where do we find support? I don't think we've found support just yet. Others like CrowdStrike stand out to me because we're retesting a major high. So when I look at the weekly chart of Apple, I see a double top pattern that potentially is emerging. When I look at CrowdStrike, I'm seeing the double top patterns to above 500. There's a double toppy kind of feel to this market as we see the reality of some initial downdrafts here. Other things that were not working, the two biggest consumer discretionary names down quite a bit. Now, outside of those two, the rest of the consumer discretionary space doing quite well today. Home builders actually having a pretty decent day. Gambling stocks bouncing. These are some names that have been pulling back so far in October, having a bit of a bounce here. So sort of like growthy stuff coming down, and some of these other things, the not AI trade, I guess, improving a bit. The financial sector comes to mind. JP Morgan is an earnings name today, down 1.9%. Goldman Sachs down 2%. Those are some pretty decent size, obviously, Wall Street names. But you can see a bunch of things like BlackRock, Blackstone, Wells Fargo, B of A, Capital One, American Express. These are all names that are having 3% plus up days. So a lot of things working pretty well this week. And these are some of the early earnings names. Again, I don't know if banks are the way that I would get a read on inflation and consumer sentiment. I think those are the two big, and like AI spending. I think banks are kind of different from those particular tailwinds and or headwinds. But for what it's worth, a nice start to earnings season. Other things to highlight as we go through. We don't have time, obviously, in a brief market recap show to go through all the charts, but Walmart breaking out of a significant resistance level. That was an alert that we had set. It fired earlier today. I popped up, my phone lit up as stock charts texted me that Walmart was breaking out to a new high. I did grab that chart to just sort of show you the meaning of that breakout, which I think is significant. So Walmart sort of reminding us of its value as a blue chip name. Caterpillar making a new high today, plowing above $500 a share for the first time. And within industrials, a lot of other movements as well. Airlines are kind of an intriguing space. They're not the most beautiful charts out there compared to others, but look at Delta Airlines with these pullbacks to the 50-day moving average. Walmart Delta kind of stuff. I'm looking at Delta and seeing someone comment about Walmart. This is hard sometimes. All these tickers thrown around. We're on Delta. This is an airline, folks. We did briefly break below the 50-day moving average. I like the fact that it recovered the 50-day and pushing a little bit higher. So we have this pattern of higher highs and higher lows. What I'm encouraged about is the fact that the momentum has remained fairly stable. So the RSI didn't push much below 40 at the end of September, as it found support around 56. So something to keep an eye. Airlines actually doing pretty well today. Those are some of the things that stand out here on the heat map. And again, it's like this is one of those days where if you take your two hands, hand number one, you cover up technology. Hand number two, you cover up Amazon and Tesla. Other than that, pretty good day. And that's the thing, right? So this is what happens when the breadth is actually pretty good, right? So most stocks were up today in the S&P. It's just the things that were down represent quite a bit of market cap. And so as a result, the indexes are kind of, weaker than you might expect, given all the green on the heat map. This is a great reminder that if you see further deterioration in kind of the Mag 7 stuff, if the AI trade really starts to struggle, there is a scenario where other things do well enough that markets are still okay, right? A bunch of banks are rallying. Those charts are actually pretty decent. So something to think about for sure as we progress through the no man's land of the market here in mid-October of 2025. All right, as a reminder, we're going to get to charts here in a few moments. I've hand-selected some charts to highlight for you, and then we'll take a question or two before we wrap for the afternoon, and I start packing for Orlando. In the meantime, I do want to thank Koifin, which has been a long-time partner for the channel here at Market Misbehavior. And appreciate their support as always. If you go to marketmisbehavior.com/Koifin, you can learn more about a platform that I have used for years, that I use every day. I primarily use it these days to dig into ETFs and think about when I look at an ETF, when I'm trying to figure out between different home builder ETFs or biotech ETFs or semiconductors or just broad market exposure or dividend payers. A lot of times there's a big disconnection between an ETF being called a dividend ETF versus the actual name that it holds. You'll find a lot of dividend ETFs hold kind of low dividend paying blue chip technology stocks because they have been strong performers and they don't have particularly high dividends. So it's a bit misleading. And tools that allow you to dig into an ETF, look at performance, look at weightings, look at what groups you're getting exposure to, thinking about a portfolio of ETFs and what exposure you're actually getting. Tools like Koifin have become a huge part of my process. On top of that, great macro data, great international equity data, which is where I use it often when I'm looking outside the U.S. I rely on Koifin to look at names from around the world. You can find more information at marketmisbehavior.com/Koyfin, Koyfin. If you use my link, you get a little better deal than you would otherwise, and it helps me make Market Misbehavior awesome. Thanks for checking them out, if you could. All right, let's look at some charts together, and then we'll be done. All right, looking at the daily chart of the S&P, don't tell me for a moment that support does not matter. Don't tell me for a moment that the market does not have memory. And I don't think it is a coincidence that today's low was almost exactly where Friday's low was. This is one of the basic premises of technical analysis, that the market has memory, that price levels matter, the price levels have meaning. It's not just arbitrary, and it's not just random walks. I mean, if you've spent a minute trading in the actual markets, you know that those things are mostly untrue. I would say what does matter is that levels tend to have meaning. We can call them support levels, we can call them pivot points, we can call them demand areas or demand zones. But whatever we call it, we have to recognize the fact that focusing in on key levels where the market has moved before can often help us anticipate where it might turn again. So it is not lost on me that as the market opened pretty weak and sold off in the early hours of the day, sold off right back to Friday's low. That happened to be where buyers came in. It was also Friday's close, also bouncing off the 50-day moving average. We've been talking about this level 65.50 as our line in the sand, or as our initial stop. Given the uptrend, this level is something we've bumped up. These are my previous lines in the sand as we go up along the way. Our most recent one is here in orange, right around 65.50. For now, it's holding. Now, we set that level back here, and we've now held it a couple times. So for now, I'm trying not to be too concerned about what I'm seeing. I'm seeing the market is pulling back, but still within a fairly constructive price pattern. We break 65.50. You will hear my approach to this market change pretty significantly as we think about probabilities of further deterioration. We think about getting more defensive. We think about not just holding on and blindly riding a market lower. Now, what would help us sort of understand how the market is evolving from one day to the next? Looking at breadth conditions, obviously quite an important part of my process, one that we like to highlight. Worth noting, as of today, with the improvement in breadth, right, the advanced decline lines were all up today. You can see that the percent of stocks above their 50-day moving average exactly at 50%. It is literally a coin flip today. If you pick a name in the S&P 500 and determine whether or not it's above its 50-day moving average. So we're literally at a decision point. Now, that indicator had been above 50% since the end of April, all through May, June, July, August, September, as we're making new highs. There are over half of the S&P names above their 50%. That has changed, above their 50-day moving average, that is. That has changed now in the last couple sessions, starting with Friday, as it broke down to just below 40%. So if it can get back above 50%, that's certainly not a bad thing and would be an encouraging sign that this market might find its footing before much more of a breakdown. But if this remains below 50%, I would say the 50-day moving average, certainly a potential issue here. Volatility is spiking. That is one of the red flags I learned a long time ago. When you have the market going higher, when you have volatility low and things just kind of feel great, you look for signs of an emergency. This comes from, really was motivated by years trying to fly an airplane. And you're taught when things are great, you always have an emergency strategy, right? You have, you use your own senses, you use the indicators and the tools in the airplane to help you understand when something's not right. And when you see something that doesn't look right, you take it, you make an effort to correct it, or you look more closely into what that means. For me, one of the most important red flags, a spike in volatility. Another important red flag, high yield spreads, credit spreads. We'll look at that in a minute. But I just want to note today, volatility increasing yet again. Yesterday, we were back below 20. Today, back above 20. If volatility would continue higher, all of a sudden, this looks a lot more like a significant drawdown that's just beginning, as opposed to a brief pullback that's now over. So we're kind of right at the point where if we go any lower than this, all of a sudden it's not like these previous pullbacks. We've had a number of them, or I've had 4 or 5 of them since the end of April. If this is just another one, we shouldn't go any lower than this, because if so, and if the VIX would push above 20, that would tell you this is something different. I think that's an important chart to watch. High yield spreads are really starting to widen out. This is not updated through today's close just yet. This is through Monday's close. But it's worth noting that high yield spreads broke out. And actually, that's probably through Friday's close because yesterday was bond markets were closed. I think that's probably true because it's on a 1-day lag, the source that I use for high yield spreads. This is basically telling you are bond investors getting nervous. And when high yield spreads widen, which means the numbers getting bigger, that means bond investors are getting a little more nervous or basically seeing greater risks. And as a result, are looking for more compensation owning the bonds of risky companies. I plot this upside down on this chart, just like I plot the VIX upside down, because when these values increase, that usually coincides with stocks selling off. So we see widening spreads. We're seeing a spike in volatility. That usually means stocks start selling off. And so we've not sold off a ton just yet. But the warning signs that I like to follow are certainly firing. One of the warning signs I followed for a long time, although, again, it's debatable now in 2025 because utilities in some ways have been sort of a growth story, right? Because it's all the energy needs of big tech and AI requires a lot of energy. That means a lot of utilities need to provide a lot of electricity. Having said that, when utilities start outperforming, I can't help. It's like the spidey sense starts firing. And I feel like we need to start being a little more defensive. Utilities have been outperforming for the last month. Since mid-September, utilities have been outperforming the S&P. Healthcare has started to outperform this month, and certainly in the last week. We're actually seeing consumer staples turn higher, as I noted earlier. It's one of the top sector. It was the top sector today. And then real estate just starting to turn higher a little bit. I mean, still underperforming over the longer term trend. But this chart, I think, is super important to see if investors are starting to rotate more defensively. We're certainly seeing signs of that in utilities, other sectors in the defensive space improving as well. All right. I'm laughing at some of your comments here. I love it. All right. NVIDIA. We'll look at 3 of the Magnificent 7 names. Another stock or two. We'll take a question. We'll call it an evening here on Chart This. NVIDIA pulling back to its 50-day moving average. NVIDIA down about 4.4% today, right? We've now gone from 195 to 180. That's 15 points. That's what, 7%. I can actually check for sure. I'm doing mental math as if that's my best option here. Sitting in front of a computer that can immediately show me, 8.5. I was close. I was close enough. 8.5% down off the high. So, again, this doesn't look like much of a move. What you have to remember is names like NVIDIA have accelerated higher. So when a little 3-day pullback looks like a little move, you're like, it's probably like a 1 to 2% move. That's an 8% drop from 195 down to 180. So this is a significant drop in NVIDIA. Now, from a technical perspective, because it's a more volatile name and because of the run that we've had, there's a lot of room for this stock to bounce around and still technically be a pretty constructive chart. So the RSI is just below 50. You want to see that hold 40. The 50-day moving average tested today. We had a couple brief failures to hold the 50-day in September. Those all resulted in bounces back above the 50-day within a day or two. That's obviously what you want to see here if you're all bullish on NVIDIA. Stocks like this going from a blow-off rally, a failed breakout to new highs, followed by a failure to hold the 50-day moving average would be a real negative development in my book, obviously with a big AI play. Meta has already blown through its 50-day moving average, arguably has now made a lower high, has definitely failed to hold this breakout level, which is around 740. We talked about that back here in August, right? When it broke above 740, what I usually share when I see a chart like this is, look, the breakout's great. I love the fact that it's breaking out. I'm going to assume that breakout's going to continue. However, if it would fail to hold that breakout level, that tells you that is a failed breakout. That implies there's not a bunch of optimism and willing buyers coming in, buying the stock at 760, 780. This tells me there's more selling into strength. And now I think in the last couple of weeks, we've seen more of that, right? We're seeing a breakdown of the breakout level. We're seeing a breakdown of the 50-day moving average. We're seeing a lower high around 740. So unless this stock can get back above 740, I'm thinking more, on the short side if I'm looking at a name like this, but certainly, recognizing the fact that we're in a downtrend. This is a stock that's not going up anymore. Amazon has now made a series of lower highs after a failed breakout of this symmetrical triangle pattern, which we highlighted in the show just after Labor Day, failing to continue above the previous swing high, now making a lower high at the 50-day, testing the 200-day moving average today. So we have Meta breaking through the 50-day and failing to hold that resistance level. We have Amazon testing the 200-day. It wouldn't take much for charts like this and this group of charts to go from looking really encouraging at the beginning of September to incredibly underwhelming here in mid-October. When I think about what the market could do over the next 4 weeks, that is a very real scenario. That's a non-zero probability that these stocks break down. And that's when things can start to accelerate. So if names like Amazon and Meta are struggling to gain their footing, what's working? A lot of financials working today after earnings season is kicking off. We're going to talk a lot about earnings, certainly into the next couple of weeks, particularly when the growthy AI kind of names come up with earnings. I think that could be a pivotal moment, given the time that has elapsed during this uptrend, given the incredibly high valuations that are being justified by anyone who's buying those stocks today. So we'll certainly keep our ears open. For now, earnings season starting out pretty good in the financial sector, with Wells Fargo testing its previous high. It did end up closing a little bit lower, but bouncing off of the 50-day moving average, regaining the 50-day today, that is, and pushing higher. So clearing 86 would be a nice validation of the uptrend, nice recovery after what looked like a potential breakdown. JP Morgan is actually one of the few big bank stocks reporting earnings not going up today. It was down about 2%. Did manage to close back above the 50-day moving average, which could end up being very important. We traded down to the 50-day moving average on Friday. Yesterday bounced higher. Today, kind of back to the 50-day moving average. Stocks like this get below the 50-day. I'm sort of foot off the gas pedal. Get below the 200-day. That's where I'm stomping on the brake, is my general analogy, I guess, driving versus moving averages. What else is working? Walmart. It's so funny. Someone mentioned in the chat, Walmart's now an AI story. You're not wrong. I was looking at Yahoo Finance earlier, just getting my head around what we saw with Walmart today. The quote was, Walmart said that customers will be able to shop and purchase items directly on the ChatGPT platform using instant checkout. Additionally, on the flagship Walmart website and Sam's Club website, customers will be able to interact with ChatGPT conversationally in the search bar. What's so interesting, I don't know how many of you have used ChatGPT. I use it every day at this point. And I've looked into these AI related tools for a lot of parts of my business and just for how others are using them to help address issues that they run into. What's so funny, I think what's so telling is with Google, right? If you go to a Google search, people tend to search in phrases, right? Cool shoes, or like a phrase, right? And you don't really have a conversation with Google. You just look for a particular phrase, and that's the code that is used. With ChatGPT, people treat it like an assistant, right? Which is how I think. I treat it like a research assistant. Hey, can you look into this person, and what would be interesting things? What books could I look at related to blah? But I don't say good books on charting. I say, can you give me some good, like you actually phrase it as more of a sense. So applying it in a customer service environment makes a ton of sense to me. I wouldn't mind a cost-free personal shopper helping you navigate a cavernous store like Walmart. But it's interesting that Walmart, which is usually thought of as a defensive play, and certainly as a kind of brick and mortar retailer, spiking because of the AI thing. However, it's enough to push Walmart above up 5%, over 105. That's our threshold. That's where we had an alert set. That's the February peak. That's the August peak. That's the September peak. Today it's broken. Breakouts are good. New highs are bullish. I think Walmart's a constructive chart until proven otherwise. Let's see if we get follow through in the days to come. All right, let's see what questions have come up here. A lot of comments about AI, a lot of comments about Chair Powell, a lot of things. Stephen, thank you so much for watching on YouTube. Bitcoin is tanking. It's the first thing the big boys sell. That's an interesting comment, and I appreciate you watching. I appreciate you weighing in on that. I don't know if I agree with your comment. I don't know if that means that I don't know what big boys you're referring to. Does that tell you that speculation is starting to dissipate 100%? Maybe we're saying the same things, but we would characterize it differently. Yeah, the reality is when you look at cryptocurrencies, there is some kind of fundamental data, looking at mining statistics, looking at wallets that are being opened, looking at flows into ETFs. I mean, there are things that you can do to sort of measure the statistics behind Bitcoin and what it means, right? And that's why I think things like Bitcoin having, it means something, because that is sort of fundamental data telling about the structural change and how that's evolving for cryptocurrencies. But day in, day out, I mean, Bitcoin has very limited fundamental data, right, to deal with. And so it really is more of a freely flowing speculative environment, right? It's sort of like if stocks didn't have company management and a bunch of fundamental data and news flow, and it was just whether people thought Walmart was a good idea right now. That's kind of what Bitcoin is like, and other cryptocurrencies. And again, there are certainly some practical applications of these things, but day to day, I would say 100% it is driven by speculation. So when cryptocurrencies start rolling over, could that be a leading indicator that a lot of heavy speculation on the upside, kind of risk on positioning, is starting to change? Maybe we're still holding our stocks, but we're selling Bitcoin and buying gold or something like that, whatever you think is more defensive. I mean, maybe, right? And I think a lot of those things, right? I mean, it's not really battle tested, right? Things we talk about with equities, we can use centuries of data in the equity markets to think about how the markets do in bubble phases. It's harder to have that with cryptocurrencies because Bitcoin's relatively new. Great comment though, and I appreciate you pointing that out. And I would agree. Cryptocurrencies going down here, I would not say would be a bullish sign for stocks. I won't attempt to pronounce your handle, but thank you for watching on YouTube. The NDX to gold MACD has almost bottomed. Usually when this happens, we correct shortly. Then gold underperforms for the next 3 to 4 months. I am so intrigued by that comment. I'm going to bring it up right now. So what you're saying is the NDX. So I'm going to do QQQ to GLD, which is pretty much what you're saying. We could debate, what are better things to use. And you were saying do like a ratio of the two and then do MACD on it. So this is kind of what you're doing. So we have the ratio of QQQ to gold. So this is going up. The NASDAQ's outperforming gold. It's going down. NASDAQ's underperforming gold. And then we have the MACD, which is sort of a trend following mechanism, thinking about that relationship. And I think what you're highlighting, which I don't disagree with, right, is when you get these buy signals, that basically, right, when the MACD goes very, very low, and then you get a bullish crossover. I mean, usually what's happened, that one ended up being short-lived, but like this one for sure, right? I mean, basically the NASDAQ outperformed gold for a while. And what you're implying is we're pretty close to a buy signal. And if we would get that next 3 to 4 months, gold would underperform, which would be the ratio turning higher. Yeah, this is actually a really good way to think about ratio charts, what you're doing here. Back in the day, this is like pre all the cool stuff you can do now with high frequency trading and stuff. I used to work with a number of hedge funds that would do pairs trading and do very manual pairs, right? They would do Coke, Pepsi, Home Depot, Lowe's, macro things like this, NASDAQ to gold, I mean, whatever things. And it would just basically, it was a market neutral strategy, which meant you weren't betting on the market to go higher or the market to go lower. You were betting on this relationship, which tended to be stable. Often it would become overextended, right? So the ratio would be kind of stable, but then it would widen out and you would bet on it coming down. Or if it'd be too narrow, it would come up, right? And that's a pairs trade where you're, long one and short the other and just betting on that relationship. And MACD and RSI and, sort of adaptations of those two indicators were the most common we would use, depending on their time frame, to sort of look for when those ratios had hit extreme. So the idea of assuming that ratio is down at a pretty low level and that eventually starts to turn higher, that can work. That could actually work pretty well. That might be a really interesting one to watch. My comment would be, don't forget that this ratio can and certainly could go a lot lower, right? You could have a similar thought like right about here saying, well, the MACD is really close to a buy signal. It took another 2 months before the NASDAQ really sold off into the April low, before the MACD continued way lower. So indicators like MACD, I have found not a great idea to anticipate the turn, but definitely important to be aware when the turn would actually play out. That's how I would think about that particular chart. Great questions, great thoughts as always. I didn't get to all of these, and I will put the ones I did not get to into our mailbag. We're planning an all mailbag episode on Friday of this week. Wednesday and Thursday, bear with me. If I can find a quiet place to do a market recap, I will do it. Otherwise, just watch on my YouTube channel. I'll be sharing some videos between now and Friday's show. We will be live at the Money Show in Orlando. So if you're attending there, please make sure you say hello. We'll be traveling there tomorrow, and then we'll be there all day Thursday and Friday. But in the meantime, have a fantastic Tuesday evening. Go Mariners. They're off today. They're back tomorrow. But have a great night. And remember, it's always a good day to own good charts. Is that it? It's always a good time to own good charts. That's the tagline. Have a great night, folks.